right, I'm back with Vince Lanci of GoldFix. We had him on last month and got some very positive feedback from the conversation. And there's a lot to talk about again here this morning. Vince, how are you?
I'm good. Thanks for having me back. And had a lot of fun last time, and I look forward to it again.
Yeah, me too. So we got this messy market environment here in November where there seems to be a lot of pressure across various asset classes, especially equities. Bitcoin ran the stops under 90,000 overnight. Yep. Gold futures had a nice little flush as well. We're popping back a bit here today, but it feels like the metals aren't ready yet, right? It feels like they're still trying to find their footing. What's your take on what's going on here in November?
First of all, messy is a good word for it, because a lot of my subscribers and myself remain bullish, waiting for the next leg. And it was my job to talk us all, myself first, off the ledge and say, no, this is not necessarily bullish or anything. But I think to answer from a metals perspective, talking about metals and commodities and everything in general, I think this commentary will also bode very accurate for miners. And that is this. There are three narratives. The first narrative is we're going to go a lot higher, and that narrative is not right. The second narrative is we're going to top, and that narrative is not right, in my opinion. And the third narrative is the right narrative, and that narrative is we're in another wide range trading range. It may not be imitating it in terms of price action because of where we are, but it's doing almost exactly what you and I discussed at the end of our last conversation. That was a wider, bigger range, but a range nonetheless. So we all got bullish, when the market cracked 4,200, and then the market just came off again. So, it feels like we're in a very whippy trading range. And as long as we don't get below the levels that you and I discussed, we still haven't gotten below them, which I think was 39.80 and then below that 39.30. As long as we don't get below that, I think it was a 40-day moving average you were referring to,
yes,
which was a nice low before.
Yes.
Yeah. As long as we stay in that range, I think the proper mindset is to just be patient. And for me, and I'm pandering here, but I mean it. For me, that means I want to buy miners, and I'm looking for dips to do so. The problem is I don't want to be just naked long miners because I think equities suck. So I want to be short AI and long miners, but I may have missed a boat on that, and I might have to wait a little bit longer. So I think everything in the metal side is go, and that's a broad statement describing November. November is messy. I mean, what were the events that we had so far? We've had a fallout of metals, Trump, Epstein, all kinds of weird, indecisive things have been happening.
Fed, big indecision out of the Fed, and Powell walking back the potential for another rate cut next month.
Right. That's right. That's a reversal. Right. That really confused the market a little bit. I agree.
Yeah, and I honestly think I wrote this morning on my Substack at Goldfinger Capital that I feel like this is almost like it's orchestrated. Like they know they're going to run it hot in 2026, and they're allowing things to cool off a little bit ahead of time. And also, I think the government shutdown is still having some pretty big after effects. I think that actually was a punch to the gut for the economy that was worse than most people thought it would be. It kind of dragged on a little too long, and then it ended with no real, resolution.
Right.
And frankly, I kind of think like you kind of have to lose confidence in a lot of our policymakers here. I mean, I think that Powell is waffling and clearly not demonstrating like he has a strong understanding of today's economy. And a lot of these Fed speeches are, this is the hardest economy to make monetary policy in. This is a very tough time to be a monetary policymaker. And while that is true, that's not reassuring to the market.
You don't get points for saying that all the time.
No,
Exactly.
no.
Focusing on Powell, everything you said, I agree with. But focusing on Powell, I was thinking about that as well from like different perspectives. One was the fact that he definitely threw water on things recently, and that's why the market started coming off. But then on the lows, my opinion, the plunge protection team stepped in stocks and scooped it up a couple of days ago, but now it's back down there. So that's the first thing. The second thing is the waffling word you use. Part of me wants to say it's intentional waffling, meaning he's letting the market, suss things out. Okay, you're getting a little too hot. He doesn't mind making the stock market drop 200 points. And that's where I was until a couple of days ago. And now I'm thinking that the waffling, to your point, I think may actually be unintended. And I think it's really poor form for a high-level bureaucrat to be saying, well, to do what what you do when you're expected to do something, but it's not going to work out. You scapegoat something, like, well, he's just saying, well, this is a hard market. This is really hard job that I'm doing here, and it's really kind of annoying. And I think there is a missing piece, or at least it's not missing in my mind, but I think I think this is, when he says it's a hard market, and I'm not saying it's not, he's also coming to the end of his term. And it's possible that his conflict of interest is, do I want a smooth handoff? Do I want to, like, for example, I'm Powell. I'm worried about my legacy, and inflation's going to be going on high, so I don't want to cut. But then we had a shutdown, so I want to cut. And then we have Trump. So I just feel like I don't see how he can be focused on doing the right thing with the last 6 months that he's in, last like 8 months. I think he's in until May. Last 6 to 8 months are going to be a comment on his legacy. And at the same time, we are running it hot, and we need to run it hot. So I guess maybe he's asking himself, how hot do we need to run it? And I think he doesn't know how hot it is, to the point of unemployment going up. At the same time, stocks are, relatively stable. So I kind of agree with you.
Yeah. I mean, I don't want to turn this into a monetary policy conversation, but there seems to be a very strong split at the FOMC right now with, like, you have Waller and Myron on one side. And I actually agree with both those guys, and both of them spoke publicly in the last couple of weeks. And I feel like they're preaching from the same songbook, and they're spot on. And then we got the rest of the people who are either really indecisive, saying it's basically a coin flip, or we have a group of like 3 or 4 that are saying inflation is too high, we can't cut yet. We can't cut again. We have to see inflation cool off more. But meanwhile, the labor market, I mean, Waller said it, I think, best on Monday, that he's hearing from a lot of businesses, a lot of corporations, that they are not hiring, and actually some are laying off, and they're investing in AI. So they're taking what they would be spending on human capital and they're putting it into AI. Now, that's a real problem for the labor market balance, because now we're going to go into an oversupply of labor potentially. And then suddenly inflation should not be a concern at all if there's an oversupply of labor. If companies are not hiring, how is inflation the concern? That doesn't make any sense at all.
Right. Wage labor will drop. I think I don't know if we talked about it last time, but I've talked about it very recently. The AI phenomena for me is cut and dry. I mean, from my opinion to from the facts to my opinion to where I think we're headed with this. And first of all, artificial intelligence gets people fired. That's just a fact, right? And some companies, and when an economy is doing well, the people getting replaced by the new technology are generally not too many of them because everyone's doing well. But when the economy starts to tick down, companies start to fire people faster. Let me just read this thing. So I guess what I'm saying is a recession, and this is the rate cut. This is the rate cut disaster that you need to cut rates. A recession will beget more firings, which sounds intuitive, but it'll get even more. There's negative convexity right now in the economy. So if people get fired, more people will get fired. So you've got, on one hand, you've got a company that's saying, well, I guess I'll wait for that guy to retire and not replace him. I'll replace him with AI. And then your profit margins are getting squeezed by tariffs or by whatever. And you say, you know what, I'll let the guy go now and I'll go with AI. And that's what AI is going to do. It's going to lower the cost of goods sold. And in doing that, if your company is doing it and my company is not, I can't compete. And so I'm going to fire people. People are going to be doing competitive firings now. And I think that's what Powell's very worried about. And to your point about it being a disinflation factor. Yeah, it should be disinflation. I guess that's why we were trying to throw so many immigrants out again, to keep things stable. It's very, as you said, it's very messy.
A Republican Party platform is no more H-1B visas, and American jobs are for Americans, and obviously, so the right is very acutely aware of what AI is doing to the U.S. labor force, and the pain, that's being felt, and I think that also ties into this whole $2,000 stimulus check thing, which is quite silly, but obviously, Trump is hearing from Myron and Hassett and his Treasury Secretary that, hey, this economy is not actually that great. We've got to do some stuff.
Right.
So anyway, look, I think that we could talk about monetary policy until we're blue in the face, and the reality is
no smarter.
Yeah, we're not going to really get any smarter and trade any better. So the reality is, gold had a tremendous move from August through October that we discussed last time.
Right.
And there's a piece you just published on GoldFix. I want to delve into this a little bit. And there's a very interesting graphic in here. I've seen this before from Goldman Sachs, showing the sort of stealth PBOC buying, the China gold buying via the OTC market in London. That's really not reported. They kind of do it in a more secretive way, and it actually dwarfed the official purchases. And one of the points of this post is that there's strong evidence that China was the driver in September.
Yes. Should I speak to that?
Yeah.
Okay. For those of you not familiar, a couple days ago, the mainstream, or whatever you want to call it, the legacy media, put out a couple comments about the Chinese physical demand. And I think that the phrasing was, the gloss, the coverage of it was essentially, Chinese demand is back. Chinese demand is 3 times as much in September as it was in August, which is true, but really not relevant because of seasonal purposes. And then another headline or two would be, China is what drove the rally. And those 3 concepts, they were extracted from that Goldman report. And they were focusing on the most recent announcement by China. However, this chart that you're referring to, and I'd be happy to give you a copy of it, has been circulating everywhere, most notably on Zero Hedge for the last 2 years. And we get a copy of it as well sometimes, and we share it with subscribers. But the chart is interesting because for the first 2 years this was going on, and by that I mean from middle of 22 through 24, nobody cared. And it's almost like some of the banks didn't know about it either because they were getting run in. But the bottom line is the PBOC, which is their central bank, is buying gold, but they're buying less and less, and their private non-official buying is increasing more and more, or staying more or less the same. And there was another piece out. I forget who it was, but basically, I think it was The Economist. Basically, there are so many takeaways from this analysis by the bank, and one of the things that we want to emphasize to anyone who's thinking that this is the top, because that's the question that comes up now from the people that have been in this rally for a while. And the answer is no. And the reason, the embedded reason in Goldman's analysis is this: the bullion banks are witnessing that central bank buying is, number one, becoming less price sensitive. So there's a little bit of urgency. So while they used to be the organization that set the floor, that's where the dip was bought, they're increasingly raising the floor and becoming impatient. Now, part of that reason could be because there's now a new consistent cohort that's buying, and that's the ETF normal investors, especially in the US, as well as in China and India too now, right? So it's possible that there is some urgency coming out of central banks in general over the competition with ETF buyers who are less patient. So it's forcing them to raise their bids. The second thing is, if China adds an estimated 15 tons in September, well, what's the average price of gold in September? I mean, I haven't pulled it up. What's the average price of gold in September? It's got to be
the average price of like 3,700.
Yeah, I mean, let me just go month.
Yeah, it was around 3,700. 3,700.
Yeah, depending on how you weight it. Yeah, exactly. So if you want to, they're still buying. They're buying right now. So it's not like they're waiting. The average price is 3,700. That means they started buying at 3,300 and kept buying at 4,000, give or take. Now, that's the first thing. So China has become less price sensitive. The central banks that are buying are also broadening. It's broadening. So Qatar is one of the banks that's buying, and they're not traditionally like heavy buyers repeatedly. They'll just buy on occasion. And the other one is Brazil. They haven't bought since 2021, and now they're buying. So, the tinfoil hat part of me says the urgency that's coming out of these nations, or the persistence with some urgency that's coming out of these nations, says to me that there's a lot more to go. Now, there's a point where I'm going to say, well, this is the top, kind of like when the smallest central bank in the world buys gold at 4,800, and I'll be like, okay, that's the top. But I see, look, China's purchases are almost 10 times what they're announcing publicly. I mean, that's all you need to know. They're buying 1 ounce publicly, and then they're buying another 10 ounces privately. So that's the whole. That's the shorter, more concise version.
What do you think China's actual annual rate of gold purchases is now? Is it 200 tons a year? Is it 500 tons a year? Is it 1,000 tons per year?
It's pathetic to say I don't know, but I will say that they export no gold, so all that gold is staying in. I would say it's whatever their stated amount is. And what have they purchased so far this year? Let me see. So it's 15. I don't know. Give me a second here.
Yeah, it's really hard to gauge because it changes a lot seemingly month to month. I mean, it seems like in 2025 their total purchases are probably above 300 tons, but it's really hard to say because so much of it is done by this London OTC buying.
Right. I would say, oh, it's a complete failure that I can't give you an answer on that. I used to really.
Sorry, I didn't want to put you on the spot.
No. I mean, it seems like an easy question because I'm trying to give the right answer. Like, China's not exporting any gold. It's buying gold and it's refining gold that it has, and it's making its own people buy more gold indirectly. So if the estimation is 300 tons, I'd say it's closer to 650, more than twice is what I would say. That's the one. And that's what they're buying. That's what they're buying. You know what I mean?
Yeah. The one thing that we do know for sure about China is they have a lot of gold mines inside of China. Right. And China also owns a lot of Chinese companies own a lot of gold mines in Africa and even in South America. And so they control a lot of annual gold production that they consume internally. So that's the gold that is consumed by the Chinese people. And some of that is obviously also taken in by the PBOC. And that's in addition to all this London OTC market stuff and the official gold purchases. Right. So it's very hard to get full visibility to all the gold that China is stockpiling. It's actually impossible, I would say.
Yeah, I mean, it is. I mean, even before they started doing this, I was trying to come up with an answer in 2017 when their buying was more obvious. In fact, I think it's even on that chart that you have there. In 2016, 2017, the reported PBOC purchases spiked, right? Between 2014, you see that red area there?
Yep.
I'll give you that chart for your subscribers. And that's when they started buying publicly. And so we were trying to figure it out. Some people that were really, really knowledgeable at the time were looking at like Cooch Jansen and a couple other guys. But the conclusion was they have so much gold in Manchuria that's off their balance sheet. They have so much gold in control, is the word you used, in Africa that's off their balance sheet. And not many people know this, but China's military is not on their balance sheet. China's military has its own balance sheet. And so they buy gold and don't report it. And that's because in these type of countries, you have the military is separate from the government. The military has to outlast. The government's changed so much historically in authoritarian countries that the military has to have its own, funding, basically. So the military buys a lot of gold. Like I would say, like whatever China says they have, the military has the same amount. And then when you add in Africa, right, all the off-balance sheet stuff, it's probably triple what they say they have. I mean, they have more gold than us. They have to have more gold than us. Not to mention the gold that's in the Shanghai vault, the futures vault, SHFE, that vault's got warrants on it now. So they're locking the gold up that they don't have, or at least haven't declared yet. So, I mean, I don't know. It's more than us. I'll give you one thing that I think is important, and no one's talking about it yet, but they will. And this will help people get an idea of how much gold is missing, sadly. Russia has about 330 tons of production a year. Now, we're talking about Russia, and they're more transparent than China, even though they're not part of the Western economy anymore. Every year since the war started, we could figure out how much gold they were keeping and how much gold they were selling by looking at what the other central banks did. So essentially, Russia produces 330 tons and they sell 100 tons. How do you know they sell it? Because Armenia's gold goes up by this amount. So Armenia, Kazakhstan, and Uzbekistan are the big buyers of Russian gold. And so basically they give Russians some currency, whether it be dollars or not, I don't know. And then that gold finds its way into the Western Hemisphere and it gets sold probably back to China. But the reason I'm bringing them up so pointedly is because in 2025, Russia has sold and exported zero gold. Zero. So assuming that they haven't stopped mining gold, that's 330 tons that Russia has not sold and not declared at the central bank level. People, I mean, so if Russia's got 330 tons that just disappeared, China's got about 1,000 tons that have just disappeared. So that's the way I look at it now, unfortunately.
Very interesting. Yeah, and there's this story about Russia buying silver, Vince. Before we get into the miners, I want to ask you about that because there are some sources that are generally credible that are reporting the story that Russia's bought $500 million of silver, but I can't find any confirmation of that anywhere. And I view that as kind of a speculative thing. What's your take on that?
Yeah, I saw those reports as well. I don't know. I haven't found anything credible either. And I think that statement comes from a Russian propaganda source. And so even though it's reputable, it's still propaganda. So everything's propaganda now. But what I will say to add to, right? What I will say to add legitimacy to it, whether it's literally happened or not yet, is that about a year and a half ago, maybe 2 years ago, Russia announced a new list of things that their central bank would be buying. And, it was like gemstones and things like that. But silver was on the list. So central banks in Eastern countries are not like Western countries. They'll buy other things and hold them as a reserve asset. And they announced back then that silver, right before the BRICS summit, it might have been the 2025 BRICS summit in May. It might have actually been like 8 months ago. They said, we're going to be buying silver for our central bank. And no one took them seriously. No one cared. But they said that. And then a month later, Bank of America comes out with a report uncharacteristically talking about silver. And they say, while the chances of silver being hoarded by central banks is very low for all these legitimate reasons, like, the nonsense reasons like it tarnishing. But the real reasons are you got to need 80 times of space. The other real reason is that it's industrial. And so if you're hoarding silver for monetary purposes, you're hurting your own industries that way. So Bank of America at length says it doesn't make sense mathematically to do that. That said, they don't have to buy a lot. Just buy 1%, and that would take the price and double it. So I believe that Russia is buying silver. I believe they have been buying silver, and I believe in a Putin-esque sort of way. Russia made that announcement because we just said that silver is a critical mineral. And whether they bought the $500 million worth of silver yesterday or a year and a half ago, they've been buying it, and they're doing things to goose the market. But before you say I'm paranoid, I don't think you would say that, but before anyone thinks that I'm paranoid, they do this in palladium all the time.
Mm-hmm.
They've been doing it for decades in palladium. Like palladium is, where can you get palladium? You get it in Russia and you get it in South Africa, right?
Yep.
Right. And Putin trades palladium like he's a trader at Goldman Sachs. But because Putin has the palladium in the vaults, South Africa doesn't. Putin has above ground storage. Palladium's, I don't like palladium, as a metal, but yet it persists in staying up. Russia is a master commodity trader, and I think they're not going to brag just for bragging's sake, for for Twitter statements or X statements. They're going to do it to see how the market reacts to it. And so when they said we've got 500 million ounces, see if it can catch some fire in the markets, and especially coming after the U.S. announcing silver as a critical mineral, it's really like a knife in the side of the U.S. If the U.S. announces it's a critical mineral and Russia says we're buying it, well, what does that tell you? No different than
it's $500 million of silver. So I think at the time of the report, it was probably on the order of like 15 million ounces, if I had to guess. And you know what I would speculate is that they bought it from their own internal mines, that some of their miners just cannot easily export it anymore because of all the the controls. And so Putin said, we'll just buy it and store it internally. And you're right about palladium, because the Norilsk mine in Siberia is the richest mine for nickel and palladium and platinum, and it even produces gold and silver too. It's literally, that mine is the greatest mine in the history of the world. It's still going after 100 years. It's very remote, very far north, but yeah, that's why they control those markets for platinum and palladium, because of that one mine. I mean, they have other mines, but that one is by far the richest one, and it makes the South African mines look like a poor man's version by comparison. Speaking of mines, let's talk about miners. So this is something we briefly touched upon last time. You told the story about how a couple of those gold mining companies got in trouble in the 90s, a margin call because they were over hedging.
Right.
Fade the scene to today. A lot of precious metals investors dabble in the miners, some more than others, simply because it gives leverage. It's more interesting in a lot of ways in terms of day-to-day action than just the physical metals itself. The miners have had a fantastic 2025, and there have been a couple of months this year where some of the silver miners just had incredible moves where, if you timed it right, you could have made a killing. But obviously they're volatile. They're treacherous. I think anybody who's been around as long as we have knows the risks of the gold and silver mining stocks, especially the junior miners. Tell me what your thoughts are on the precious metals miners here, and how you might, utilize them in a portfolio.
Yeah. I will. Okay. So just speaking about the backdrop, on miners is they're at their potential to be the most profitable in almost 50 years. Free cash flow, based on all-in sustaining costs. And one of the things that has made me shy away from miners historically is exactly what you said. As a trader, I would rather have financial leverage in my trading than operating leverage. So when I look at a miner, I say, well, what kind of leverage do I want? I want operating leverage when the market is going up, and the market hadn't been going up for a long time. But now things are going well. Energy costs seem to be under control. Operating leverage is the way to be. So for me, I bought bigger companies. I didn't buy juniors. I don't pretend to know the management. I think, just to go back to harken back to what we talked about over-hedging, they're under-hedged now. Okay? And Wall Street, which unfortunately has a big effect on these companies, has been reticent to recommend them, and probably were short them for years because they didn't like how they were run. But now they're starting to embrace them. And I think, just speaking as a narrative, as a person who watches narratives, I think Wall Street knows that their time has come. And if I think, for me, right? I mean, what's going to happen and it's happening right now, is every time markets rally, miners are getting bought, and every time markets drop, AI stocks are getting sold, or Mag 7 are getting sold. So over time, I think you're going to continue to see miners do well. The ones that I'm personally focused on, because I don't tend to know the management, are the majors. And I focus on the majors because they're the ones that have the operating leverage. They can throw another bulldozer on it and pull more metal out of the ground. Number one. Number two, if they have good management and they understand their international risk, then, like, for example, Freeport, I think, has good management, but now they have international risk. I mean, Indonesia is going to tariff Doré bars going out of there, so that hurts Freeport. So I'm having a hard time consolidating on one or two companies. So I'm diversified, or I will be diversified. I was diversified before, and I'll buy companies that have strong free cash flow and management that is seeking to maximize shareholder value, which is an old trope, but it's true. So either they're going to give you the money back after hedging, or they're going to go out and buy something that needs to be bought before hedging. And that's where I am. One thing I would like to say that just became obvious to me recently is that when people talk about the juniors, people like myself who aren't completely mind literate at the individual level, when you talk about, say, the GDXJ, that's not juniors. Those aren't juniors. Those are big tier companies, right? I'm not crazy, am I?
Yeah, no, you're not great. Well, okay, so this is actually a great topic. So in the gold mining sector, there's basically three definitions, but it needs to be expanded to 4 or 5. There's the senior gold producers. A senior gold producer is like Barrick or Newmont, and it's by definition 1 million ounces of gold production per year or greater. That's a senior. Mid-tier is basically anything from like 300,000 ounces to 1 million ounces. They get thrown into the mid-tier category. So that's actually not fair, because a company that's producing 800 or 900,000 ounces of gold per year is a pretty big company in 2025, probably with a market cap on the order of $3 or $4 billion. That's or maybe even more. I mean, if they have a strong outlook for growth, if they have some good pipeline projects, 900,000 ounces a year might be a 10 billion market cap, right? So that's not really a mid-tier anymore, but we still use that old definition, mid-tier. And then junior is any company from the exploration stage to a small one asset miner that might be producing 100,000 or 150,000 ounces of gold a year. That's a junior. So really, it needs to be expanded into like 5 different categories, because obviously an exploration stage company that doesn't even have a deposit that they can say, hey, we've got 1 million ounces of gold here. They can't buy the law, the 43101 law. They can't say that they have a deposit yet because they haven't put a resource on it. They haven't drilled enough. That's a junior. But also a producer that has a couple of small mines in Mexico that might produce 1 million ounces of silver and 50,000 ounces of gold. That's a junior too, because it's a smaller company that doesn't fit the mid-tier status. So yeah, you're right. The GDXJ has some big companies in it, so it's really not a junior ETF.
Thank you for explaining that to me, because I think that's important for me, because I'm trying to get away from like, I'm going downstream. So it's like Newmont, Barrick. All right, so let me start looking at other, and I think that's what's happening in general. Consider me a normal mining investor, that I'm now going downstream, and I'm looking, I'm like, the juniors aren't really that small. The ones I'm looking at, these aren't juniors. I should be looking at them more. And so I would say, if you know the industry, and you do, I would say it's probably, but you're still conservative, it's probably time to start looking at, from my point of view, well-capitalized juniors and producing juniors, at least as the terminology goes, and not lump them in with explorers. They're not juniors. They're middle class. They're mid-tier. I mean, they're they're not juniors. Junior's just the wrong word, right?
Yeah, it's the wrong word. So there's 2 there's two categories that kind of fit the bill for what I think you're talking about. And that would be either an actual junior that has a big asset. So they have a big deposit, but it's not in production yet. So they might have 8 million ounces of gold in resource. Like there's not a huge amount of uncertainty if the 8 million ounces is there. They've drilled like 500 holes. They've done all the modeling. They've had an independent firm come and model it up, validated it. They've got the 8 million ounces. It might be 7,800,000. It might be 8,200,000, but it's somewhere around 8 million. But they're not in production yet. So then, in that case, you've got a gold optionality play. Right. You got 8 million ounces in the ground, but when will they start to produce? And that's where you actually need to do some research on. Okay, how hard is it for them to get the permit? So you got to expend a little mental energy there. You got to know the jurisdiction. And then you got to know the management team a little bit to see how well they could get financed, right? Because probably a mine that size is going to cost over $1 billion in terms of the initial capex, right? But
yeah, as a finance guy, my initial thing was like, wait a minute, that means no operating leverage yet. That means all financial leverage, right? Okay, yeah.
So that's one idea. The other idea is a producer that actually has a producing mine, but it might be a single asset company, right? So it's like there's some companies in Canada, there's some in Mexico. Talisker is one in BC. West Red Lake is one in Ontario. So they have a operating mine. They have a permitted operation. They're producing gold, but they're not at a big enough level that you can say they're like a mid-tier yet, right? They're working their way up. They're trying to fine-tune operations. And it's a process at some of these operations, right? Especially in 2025, where really skilled mining labor is not so readily available. It's not like it was, 50, 60 years ago, right? So, but producer, so you can look at their financials because they're producers. You can actually see, okay, what's the cost here? What's the corporate overhead? You can use some of your financial statements, skills on those companies, and you've definitely got leverage to the gold price because they're producing, right? So when gold goes from 3,100 to 4,100 in a few months, their next quarter is going to look a hell of a lot better than the last quarter, right? And the Citi, the piece that you put on GoldFix that was excellent, and I'm still studying, the Citi graphic showing basically like high cost gold miners and what their margins are at 4,000 or 4,100. Like literally in 2022 and early 2023, these companies were break even, or some of them were even losing money at those gold prices. Yeah. But now
is that the blue line?
Yeah. So in 2022, it dipped down to actually negative. So the average high cost gold miner was losing money for a couple quarters. And now they're the most profitable in history because like high cost is like 2,000 an ounce. Like, that's the all-in cost. Like 2,000 is high cost. Like 2,300 is really high cost. But if you're selling your gold at 4,000, you still got a very big margin, right? So that's the point that Citi's making. And actually you can pull up a lot of these companies because there's a lot of examples of miners like that were literally on life support a few years ago, and even silver producers, like, because people just think that like, okay, if silver goes from 20 to 50, the silver miner's got to be a cash cow. Well, not really. If they're not able to ramp up their production, if they're not able to scale, and they have a lot of
it's operating leverage,
like if it's just a small asset, if it's a small deposit, it's just not gonna turn on like that. Yeah, I mean, obviously 20 to 50 is gonna help them out a lot, but it may not be like the kind of move that some people think they're going to see on the share price. Now, there's plenty of examples of miners that are cash cows here in the last year and a half, including Newmont, obviously. Lundin Gold has just absolutely, knocked it out of the park. There's so many other examples, but the free cash flow is off the charts, quite frankly, right now.
So I have a question for you then. I mean, an observation that will probably definitely demand a comment from you. If looking at this is for myself, right? So maybe some of your listeners will want to know this as well. If the juniors are a mix of producing companies and non-producing companies, I'm using my own terminology. Mm-hmm. So explorers who may or may not have assets proven, and companies that have an asset that's producing. So if I were to just blindly pick an asset that's producing, then what I could be doing is, if they're constrained by finances, they can't lever up. If they're constrained by operations, they can't lever up. And if they don't have any new prospects, there's limited growth. So they could be punished. And then on the explorer side, well, that's obvious. If they don't find it, they could be punished as well. So it feels like if I were to go into the junior area, or at least the so-called junior area, I should say, I would want to kind of barbell it, get someone unless I can find someone who's producing and has prospects to produce more, I'm going to have to buy an explorer with some proven reserves and someone who's actually producing. I mean, I'm looking at it like, how else am I going to have? It's like a portfolio of teenies, which they aren't teeny anymore, but it's like a portfolio of a diversified portfolio. You buy 5, 3 goes sideways, 1 goes to 0, and 1 goes to infinity. 3 goes sideways higher.
Yeah, I mean, that's right. I mean, if you're dabbling in the junior space and you buy, let's say 10 names, you should expect that 2 or 3 are just not going to work out. That they're just, it's going to be, for all intents and purposes, a failure. And look, I mean, obviously, at the producer stage, there's a level of being, the risk is lower because they've already permitted. They're already in production. But is there still risk? Yes, for sure. Well, aside from the metal price risk, there's the operational risk, right? Like Freeport just had a huge accident at the Grasberg mine in Indonesia. And Freeport, as you said, has excellent management. And even they had a major mine accident where 7 people died, right? So it's a tough business. It's a tough business. There's no way to completely eliminate that risk. But, usually the trend is your friend, and in mining too. So when a mine has been in operation for 2, 3, 4 years, and there's been no fatalities, there's been no major accidents, and their production continues to trend up, well, that's a very good sign. And that's probably the miner that you want to own, quite frankly. Another kind of sweet spot is when they're first moving into the production stage of the mining lifestyle. So they're finishing the construction. They got the permits, they got all the permits, they built the mine, they're finishing up the mine build, and now they're moving into cash flow and pouring gold, right? And that's the sweet spot. That's actually a very nice sweet spot in that curve, where even if the gold price stays flat, the stock should do very well, double, triple, something like that over a 12-month period, right? And if you also manage to time it with a rising gold price, well, that's nirvana, right? That's where you get the 10x moves, where they're moving from construction to cash flow, and they're ramping up the cash flow. They're pouring more gold every month, and you get the gold price going up 30-40%. That's where you get the really big juice, and we've seen some examples of that in 2025.
Right. Interesting. So I'm thinking about it, just backing out a little bit from the concept of what you're talking about. Miners make money now, and I don't just mean profitably. I mean, they mine money, and nations are going to be more and more protective of their gold supply. I think if you can find an American or Canadian miner, uh, I think American miners are probably where to buy now, because look, this is the kicker that I'm looking for, and it's not on many people's radar, and I don't know if it's even valid yet, so I'll just throw it out there. I'm looking for American miners that are in the process of being approached by other foreign miners that want to do business with us. So the one in South Africa, I forget the name of it. I think it started with an A.
Anglo Gold Ashanti.
Yeah, that one. No, not Anglo Gold. A newer one. No,
Sibanye.
Yeah, that's it. Starts with an S.
Sibanye. Yeah.
Yeah, Sibanye. I mean, I'm seeing that. Look, we're opening roads up in Alaska for oil and for mining. I think American miners are going to be protected, not nationalized, but protected by the government. And at the same time, on the financial investor side, on the financial side, banks are now telling investors to put 1% more of your money into mines. I mean, into gold. And I just think that they're not just printing money, they're mining money. I mean, here's an example. If you were to increase, this is according to Citi as well, if you were to increase the wealth, the North American wealth assets by 0.1% into gold, that would take 1.2 years of mine supply to satisfy. And I'll give you another number, and then I'll tell you why I think it's important. If you were to take 1.5% increase into gold, that would take 17.9 years of above ground mine supply. Now, this is where I feel very comfortable in an expertise sort of way. Gold forever has been a stock trade, not a flow trade, which means the mining production doesn't matter. It's the above ground gold that just goes back and forth. Now, the reason this Citi report raised an eyebrow for me is because they started measuring gold as a flow trade, meaning if you look at gold, say, versus oil, for those people not familiar with the terminology, oil is a flow trade. It's bought, it's used, you can't get it back. Where's the next ounce of oil coming? And that's a flow trade. You got to know where it's coming from. Gold, it's bought, it sits there, it doesn't get used. Who gives a crap about the mining production, because 99% is above ground anyway, or whatever the number, 97%. But now banks are starting to look at gold like it's energy. And I'm not even getting into the analogy. I'm just saying what they're admitting, whether they mean to or not, is that mine production for the price of gold has gone from being not really that important to being really important and a significant measure of the price action coming forward, because they're assuming that all the above ground gold that had been going back and forth, whoever wants to buy it, satisfying demand, is no longer available. You can't lease as much as you used to. The BRICS took all their gold home, and they're still doing that. And demand is now starting in the West, or the Eastern European countries, and West as well. They're just not talking about it. And I'm bringing this back to miners. If mining production is now at the forefront of estimating gold's price in the future, then mines are at the forefront. And so gold becomes a proxy for mines. Look, if you're bullish oil, you know what you do? You buy Exxon, or you buy a producer, because it's a flow business. They have this cash flow. Gold, you don't look at it that way. What's proven? Well, I think the future provenings, if that's a word, will matter a lot. And so that's why I want to find some good miners to own, because I believe that the gold market has become a market where we're no longer interested in what the gold is above ground, because it's all spoken for. It's all used. We want to find out where the next ounce is coming for. And that's why I think miners really could catch a fire as this mindset changes.
Yeah,
Gold,
that's a
commodity.
profound statement. So it's not provenings, it's resources. So
Yeah, exactly.
the gold mining companies like Newmont, they have reserves, which are highly proven gold deposits with a
Right,
lot of drilling. That's the highest category. It's proven and probable, reserves. And then they have, resources, which are more on the exploration stage, but still they've been drilled out to a pretty high level of certainty, but not to the quite proven and probable level that you can put into a bankable feasibility study and get a loan from a bank to build the mine. So that's a very powerful concept that you just introduced, that the above ground, like jewelry, like the
yeah,
gold on my finger, like when gold went from 2000 to 4000, I'm not going to go sell my ring because it's now doubled in value. And there's a lot of jewelry, there's a lot of above ground physical metal that's just not moving. Like, even though the value doubled or tripled, it's not mobilizing, it's not coming into the market. And so the city post kind of makes the point that, like, the value of the above ground gold stocks have tripled since 2010, and that's
and the scrap recovery hasn't tripled. That's
right.
there's no one's selling. Right.
So you want to be a gold bank, you want to have gold in the ground, like Newmont, like Barrick, like Kinross, right? And so actually something very interesting is happening in the gold mining sector right now, where there's all these Reuters reports that Newmont is about to make a move for Barrick, or at least Barrick's assets in North America, because Barrick and Newmont have this JV where they basically share a bunch of mines in the U.S. and in the Carlin Trend. And basically Newmont's now the giant. Barrick has had years of underperformance.
Right.
And so Newmont has the opportunity to just take it all, to acquire all of these assets across the Americas. And so there's a lot of speculation. Actually, if you look at the Barrick chart, which is now B on the NYSE, it's at a multi-year high. I think it's like a decade high, and it's finally outperforming. And this is due to this deal speculation that something is about to happen, and Barrick is no longer going to be a publicly traded entity, that they're gonna get swallowed up here shortly. And so that would, if that does happen, if Newmont does make this move and makes the biggest deal in gold mining history, that would give further validation to your point that now we're in a competition for acquiring more gold reserves and resources in the ground that will be valuable at a later date.
Right. I mean, yeah, that's exactly. Leverage buyout activity or consolidation vertically will unlock value. I don't know which miner is going to unlock which miner, but I know that whoever has or gets the resources wins if this analysis, if this perception is right. And I think it is. I mean, come on, the U.S. is basically buying percentages of tech companies and rare earth companies. How would they? Maybe they don't want to buy a piece of a miner, of a gold miner, and I can understand why they wouldn't, because it just sends a horrible signal about your own money. But they're going to do everything they can to facilitate self-sufficiency in critical minerals, and gold is a critical mineral. It's money. That's basically it, and that's why I come down on. There's something I want to mention. You started off talking about referring to the fact that we're talking about how they overhedged back in the O's. I want to bring up something that I think is very significant as a person who understands the hedging market. I'm very concerned about how companies hedge, because I saw Ashanti and Cambior go under because they overhedged. And interestingly enough, and this is a plus, if I could find the list of miners that Citi's advising, I would buy them. And I'll tell you why. From a trader's point of view, from a hedging point of view, You see, the miners that went under or poorly performed either didn't hedge on the way down, and so they had no cash flow, or overhedged on the way up and didn't have any profits, with Ashanti and Cambio back then being the worst in 99. Now, this is very important. Citibank has advised the oil industry for 20 years on how to hedge their production, and they've done a very good job of it. So I happen to know what they do because as a trader in energy, I used to be on the opposite side of their trades. And their trades were simply to buy a put. This way, if it goes down, you're going to lock in your profits. And to sell a call, which if it goes up, you don't make as much money, and you use that call to offset the put. That's what all the miners used to do. And when the market would go up above a certain price, they'd stop making money. And they didn't have any operating leverage to scale up, and so they just kind of sucked. Now, the reason I like Citi's approach is because it's the oil approach. Citibank, they say it in this report, Citibank is going to tell their clients to buy a put, just like they do with their oil people, to sell a call, just like they do with their oil people to lock in profits, and then to buy a higher call for a kicker. In trading terms, we used to call that a three-way or a staggered collar. You collar the risk, but you buy a kicker. And so if back in the day, if Ashanti and Cambio had something like that, when gold went up, they would have stopped making money for the next $50 and then started making money for the next $500. I think whoever Citi is advising is probably going to do the right thing, and that is hedge production for cash flow, buy insurance, and finance the insurance by selling calls, and at the same time, own a call on the upside. Meaning, I think in the extreme move, whoever Citi's advising is probably going to do really well, because I know that the energy companies they advised did very well. They advised Petrobras in energy, and they advised Pemex. And in fact, it's in that analysis that they told them what to do, and they all made money. If you look at the energy markets in the world, Mexico's energy market was very profitable in the sell-offs and the rallies. I would think that whoever does what Citi suggests is going to be very profitable as a miner. I hope anyway.
It's very important that they get that third option where they buy the higher strike call, because the problem I see with hedging as a gold producer, if you're just hedging your product but not hedging your expenses, then it's totally asymmetric, and you're limiting your upside on your product, and you're exposing yourself to unlimited cost escalations in terms of your operating expenses, which could be diesel, which is obviously labor, which could be taxes, electricity, et cetera, right? There's so many expenses involved with a mine. Yeah. So if they hedge in a way that keeps them open to upside,
right?
But also, limits the downside a bit. Okay, as long as that's not too costly to do, okay, that's fine. Or if they can Newmont, I think Newmont and Barrick hedge a little bit of their fuel expense, but it's not substantial. And actually, if you look at Newmont, which is the biggest gold miner in the world, their sensitivity to crude oil is not even that big. I mean, it's a huge company, but if oil goes to 100, it hurts them like $100 million, like on a yearly basis. That's not, for a company with like 10 billion in revenue plus, like that's not even a big deal,
Right. And it seems like, we were talking about in 22 when some of those companies were negative on their cash flow. That was when oil was at its highest, and at the same time, the Fed was raising rates. So, I'm not talking about Newmont, but I'm talking about that is some of these firms have costs that will scale up as the market rallies. But if their profits don't scale up, to your point, what's the point of owning them?
Yeah, no, that's the big thing, right? And yeah, so like, yeah, I know Barrick got in a lot of shit in the 2000s, with their hedge book.
Yep.
And basically it was because they were limiting their revenue, their profitability during a rising gold price environment, because they had been so entrenched in the 90s mindset of like gold is never going above 400. So
Right.
we should always sell calls when gold goes to 380, 390, 400. We should be selling calls because it's never going to hold above 400, right? And then all of a sudden, 2004, boom, you get this big breakout, and their shareholders hate the management for it because, like, why do I own this stock if we're not making more money as gold goes up $100?
That's the industry, right? I mean, coming out of the 80s, they were all Texas hedgers or not hedging. And then going through the 90s, especially when you see like with the Ashanti and Cambio collapse, you see the other miners going, well, shit, I don't want to have that problem. But by the same token, they want to make sure they hedge their cash flow. I mean, that's what drove a lot of these miners down, the fact that they swung from being no hedgers to being over hedgers. So
yeah.
But now hopefully they're in the right place. See what here's like, I'm just telling you, like, as a trader who's been around, what Citi is preaching to their clients now, energy guys started doing in 1987. You follow? Like, the energy industry has been hedging its production properly for 25 years, and miners have not. And now they're just coming to the big boys table, and that means bigger valuations. That means maximizing shareholder value, and it means responsible hedging. And
responsible hedging. That's the key. I think if they hedge some of their production, a portion of the production profile, and also hedge a portion of their energy risk,
right.
I think because Vince, like with crude oil at $58 a barrel, they should have all their energy costs hedged here. Like, they should have it locked in at this level as much as they can.
Right.
If somehow another war breaks out, or Venezuela, God forbid, and oil spikes back to 100, and some of these miners are exposed to that move, and suddenly in their next 6-9 months from now, they're on their quarterly call saying, well, we had an extra $120 million of diesel expense, and like, what? You should have hedged it down at 58.
Right. Well, that's the thing. That's when you integrate the whole expense versus profits thing. If oil is trading $58, let's make it obvious so people understand. If oil is trading $20 and gold's trading $6,000, a miner with resources should be buying oil calls and selling gold calls. Because if it does go up and their profitability is limited or capped, at least they'll have this increasing cash flow from the oil calls. I mean, it's like they're not hedging expenses, but they're hedging production, which is what your original point was. That's right. That's right.
By the way, I like to end it on this note. Perpetua, which is a junior, they have a 5+ million ounce gold deposit in Idaho with antimony. Right. They have a big antimony kicker, and they got all this. Yeah, they got all this funding from the Department of War. They got a big loan from the government, and like, I was in Idaho last month, Vince, and I was at this conference, and this news release drops on a Monday morning. JP Morgan Chase invests $75 million in the common equity of Perpetua Resources, a junior mining company. Have you ever seen JP Morgan Chase, the actual bank, do a private placement investment with a junior mining company?
No, I haven't. That's the what do you call it? That's the point of the spear. And just to give you the energy parallel, in the O's, when energy was being deregulated, JP Morgan was doing private placements with energy firms and power manufacturers, like utilities in Texas. They're ahead of the curve when they see government policy change. And put it this way, Perpetua was bought by JP Morgan.
Yep.
Well, 10 years, the industry is going to be doing very well, in my opinion. There's your headline. Don't say that, but we're going to be doing, Like,
yeah, when I saw that, JP Morgan is investing in the common equity with like no real sweeteners, like there's no kicker. Right. Yeah, and there's one thing in the news release where they can like buy more stock next year at like 20 or 30% higher share price. I mean, like that's their kicker, but I mean, still that's fantastic. That's a normal kicker, and that's fantastic for Perpetua because they're doing these financings at all-time high valuation levels, and they're getting the valuation, the validation of JP Morgan Chase as a shareholder. So that was mind-blowing to me as somebody who's been in the mining industry as an investor for 20 plus years. I've never seen news releases like we've seen in 2025, and the fact that JP Morgan Chase is taking a position in a junior, like that's a legitimate junior. They're just starting the mine build. They're not a producer yet, so they're a junior. They have their permits. That's a big milestone, big event for the company, but they're still a junior, and they won't be in production for a few more years. So the fact that JP Morgan is willing to put in money here and wait, I think is a big deal. And like you said, like that's the tip of the spear. US and Canadian miners are where I think I want to be invested for the next couple of years.
Right. You think Canadian miners will be targets for American miners?
We saw it. Core just bought New Gold. So Core is based in Chicago. They're formerly from Idaho. CDE, they're one of the silver stocks that you play when silver is moving. They went up to Canada and they bought a bunch of mines in Canada. So yeah, it's happening. It's happening on both sides. You know, the Canadians are coming down to the US, and you know the Americans are going up to Canada.
Interesting. Yeah, so it's the right industry to be in. And I'll tell you, they haven't even started pitching it yet. Wall Street right now is still trying to get people out of tech stocks without really talking much about miners, but they will. It won't be miners, it'll be natural resources. And it'll be like 80% miners and 20% energy, whereas it used to be 90% energy, 10% miners. That's it.
Vince, thank you. This was a great conversation, and we went longer than I planned, but hey, gotta let it flow.
No, it was me interviewing you. I need to bone up on this shit. So the sweet spot of juniors is what I'm looking for. Something that's about to hit the convexity, like Perpetua.
Perpetua is a good one. Yeah, Perpetua is a good one. I mean, honestly, that's one to just look at on dips. I think it's PPTA on the NYSE. I actually don't own it here, but it's definitely on my watch list, and it's a stock I've traded before. Yeah, and the single asset gold producers are very interesting because you get a lot of leverage there, especially if they're ramping up, right? If you look at their mines and you see that they have, you know, reserves of a couple million ounces, and they're only at like a 50,000 ounce, you know, run rate right now, but they can grow to 100 or 200,000 in the future. Well, then you get the operating leverage on top of the gold price torque, right?
Right. So let me ask you a question. I'm sorry to ramping up, that phrase, does that mean using operating leverage, or does it mean using operating leverage and drilling for more discoveries? Like,
well, that's a good question. So when I say ramping up, I mean like right now they're producing 5,000 ounces of gold per month. But 6 months from now, they'll be doing 6,000 or 7,000 ounces of gold per month.
Proven, ready to go. Just need some machinery thrown at it.
Yeah, and meanwhile, they're still drilling because they're always drilling to find new ounces of gold to put into the reserve stockpile. And you know, like any good mining company with a good deposit is always drilling. They're always finding, stepping out, seeing how big the ore body is, and proving up some of the existing areas, you know, inside of the ore body. And also they have to open up more levels to get deeper or get further along strike into the ore body. And that costs money, right? Because you're essentially moving a lot of earth to get to the gold, right? And so you're doing all these things simultaneously. And so but basically just to keep it simple, when I use the term ramping up, I'm thinking about a situation like this. Currently, the company is producing 50,000 ounces of gold a year. Next year, they'll be producing 100,000 ounces. And then 3 years from now, they'll be at 200,000 ounces per year, right? So that is the perfect situation where we have the operating leverage with the leverage to the gold price.
Right. Gotcha. That's your sweet spot. Thank you very much. Thanks for having me on.
Thank you, Vince, and thank you for all your fantastic content. And I'll definitely include the China chart and the Citi chart with the gold miner margins.
Yeah, it's the gold miner chart is, both of them are eye-popping in different ways. Like, look at that vertical line on the Citibank chart. I'm like, holy shit, man. Like, why are the stocks not doing that? And it's because everyone's like, oh, they're miners. They're going to overhedge or they're going to underhedge and they're going to screw everything up. No, I want to find out who Citibank's clients are. Those are the ones that'll hedge properly.
Yeah, why don't you find that out in the next episode? We can talk about it.
I'll do that.
Thanks, buddy.
Thanks, man.